Good morning, everyone, and thank you for taking the time to join us for our 2023 full-year results presentation. Before I start, I'll let you read this slide to explain the basis of reporting. Reference is made throughout to adjusted results, which reflects continuing operations, excluding exceptional items, as reported in our annual report and accounts for the year ended 31st December 2023. A reconciliation of adjusted results to total results is included in the appendix to the presentation. This is the running order for this morning. I'll provide an overview on the year and comment on our growth potential, some key metrics, and share the progress made last year and over recent years. Rachel will then cover the financial performance in more detail before I comment on the progress made by each of our businesses. Over the last few years, we've made significant progress, continuing to take a prudent approach to assessing customer affordability, and we remain focused on supporting our consumer and business customers in this challenging environment. The group is more focused and simpler, following our decision to exit a number of subscale businesses. We've improved the quality of our consumer lending, have grown our net lending by £1 billion since the end of 2020, have an improving cost-to-income ratio, and have significantly improved our profit pre-impairments. We have confidence in our ability to make continued progress and deliver on our optimising for growth strategic priorities. Overall, this is a good set of numbers, and I look back at what analysts were forecasting for 2023 at this time last year, and we have outperformed against their expectations. These numbers represent a lot of hard work against a challenging macro backdrop, and I'd like to thank my colleagues for their hard work and dedication. We've grown strongly in recent years. Our net lending was 52% higher than 3 years ago. We operate across a diverse range of large specialist lending segments, serving both consumers and businesses and delivering attractive margins. We've established positions in our markets and have long-standing relationships with introducers, which we continue to expand and nurture. With a stable and efficient funding model, we're a resilient and agile business and have proven ourselves to be adaptable to market conditions. We still have excellent growth potential in large addressable markets and are confident in our ability to continue growing in each of our businesses. We've demonstrated our ability to identify and deliver operational efficiencies. As outlined at our Capital Markets Day last November, we'll now deliver £5 million of annualised savings from our Project Fusion cost optimisation programme by the end of 2024. We won't stop there, though, and continue to identify opportunities to drive further improvements. Our disciplined approach to managing our costs as we scale our lending supports a more ambitious target for our cost-income ratio of 44 to 46% against a £4 billion net loan book. Ultimately, our focus is on delivering an improvement in the returns we generate. Building our net loan book prudently towards the £4 billion level supports delivery of a 14 to 16% return on average equity. As you'll be able to calculate, that is now on the horizon for us and requires lower growth rates to achieve it than we have delivered in recent years. We delivered record levels of new lending in each business last year and have delivered a strong, consistent financial performance. We're on track to deliver major enhancements in returns. You'll be familiar with this group overview slide from previous presentations. I'll talk about the progress made in each of the businesses later. The key message, though, from this slide is that growth we have delivered in each business as shown at the bottom. Consistently across all areas, we've delivered on our commitments to scale our businesses, and there's much more to go after. In the last 3 years, we've grown lending in our consumer businesses by 87% to £1.7 billion, and in business lending by 27% to £1.6 billion. Consumer lending now represents 51% of total lending, compared to 41% in 2020. Deposit growth has also been very strong at 44% in the same period. 2023 was another year of robust progress. Some key performance metrics for the year are shown on the slide. Total lending balances grew by 13.6% to £3.3 billion, and our customer savings balances grew by 14% to £2.9 billion. We've consistently highlighted our growth potential, and I'm delighted with our progress. On the back of strong lending growth and disciplined cost management, our profit before tax pre-impairments of £85.5 million was 12.4% higher than in 2022. The cost-income ratio improved from 55 to 54%, and costs in the second half of the year were flat compared to the first half. Our net interest margin for the full year was consistent with the first half at 5.4%. This remains close to our medium-term target. We have, of course, experienced increases in our cost of funds in a rising rate environment. The refinancing of our Tier 2 capital, which provides capital to support our future growth, also impacted on net interest margin. Risk-adjusted margin was 4.6%. The board has approved a final dividend of 16.2 pence per share, in line with our policy to return 25% of earnings to shareholders. This brings the total dividend for the year to 32.2 pence per share. I can advise that the board has decided to move to a progressive dividend policy for the 2024 financial year, reflecting feedback from shareholders. We continue to show good momentum towards achieving our medium-term targets. The charts on the slide show the progress on each of these, including the recently enhanced targets for lending balances and cost-income ratio. The first chart demonstrates the progression in building the scale of our lending balances as we move towards our 4 billion ambition. We planned for our net interest margin to come down as we scaled the business lines and focused on increasing the mix of lower risk consumer lending. We remain comfortable with our target for net interest margin to be around or above 5.5%. I've already commented on the further improvement in cost-income ratio, and you can see that demonstrated again here over a longer period of time. There's been a 600 basis points improvement over the last 2 years. As we continue our growth trajectory, we will see this move further towards our refreshed and more ambitious target. We delivered an increase in our return on average equity, which remains our key financial priority. As expected, we've consumed capital as we continue to deliver lending growth. That will remain a feature as we keep growing our businesses and until we achieve the 4 billion loan book threshold. As a reminder, our medium-term target for CET1 ratio to remain above 12% is comfortably above our minimum regulatory requirement of 9.6%. We remain confident in continuing to grow and delivering these targets. As you can see in the bottom half of the slide, we're also clear on the level of loan book scale that is required to deliver attractive mid-teen returns. That requires us to get to £4 billion, maintain our credit discipline, increase slightly the mix of lending towards our consumer businesses, and maintain focus on controlling our cost base. At that point, the group becomes capital accretive, and we'll have different options to consider and choices to make. Let me now hand over to Rachel.
Thank you, David, and good morning, everyone. I'm now going to provide you with some further details on our financial results for the full year 2023. I think these results represent a solid performance against a challenging backdrop. 2023 saw a continued focus on net lending growth whilst maintaining strong credit discipline and cost management. Growth has been focused on higher quality lending, particularly in our consumer finance businesses. Average net lending growth of 14.8% generated an 8.9% increase in operating income, and this has been achieved with a 7% increase in costs, which we believe is a strong performance against a high inflation backdrop. This has resulted in a significant increase in profits before tax pre-impairments of 12.4% to 85.5 million. Impairments did increase by 15.6% to 42.9 million, but were impacted by the previously announced single loss in commercial finance. Excluding this loss, impairment would have reduced by 3.8% year-on-year. Adjusted profit before tax improved by 9.2% year-on-year to 42.6 million, and return on average equity was 0.2 percentage points higher than 2022 at 9.6%. On a statutory basis, profits were impacted by 6.5 million of exceptional costs. Following the FCA's Borrowers in Financial Difficulty review across the industry, and in response to specific feedback we received on our collection activities, costs of 4.7 million have been incurred or provided for. In addition, costs of 1.8 million were incurred in relation to corporate activity that took place in H1 2023. Taking these items into account, continuing profit before tax was 36.1 million. The group's net interest margin remained consistent with the first half at 5.4%. This was 30 basis points lower than in 2022, but reflects our focus on increasing the mix of lower risk lending. The last 2 years have been challenging given the steep rise in interest rates, but we have actively managed the repricing of new lending and retail deposits to maintain margins. Asset yields have risen by 2 percentage points in the year as base rate increases have been passed on, and a 2% mix increase in consumer lending has also delivered an additional 0.3 percentage points. Liability yields have increased by 2.5 percentage points, reflecting the repricing of our customer deposits and the maturity profile, with circa 60% of funds repricing within 1 year. The new Tier 2 capital also reduced NIM by 0.19 percentage points, but provides important capital for our growth strategy. Margin management will continue to be a focus in 2024. The potential for falling rates, active management of pass-through, and mix increases in consumer lending will be our levers to drive margin expansion in the medium term. We remain comfortable with our medium-term target for net interest margin to be 5.5% or above. The key to achieving our medium-term target of 44 to 46% cost-income ratio is through growing our income at a faster rate than our cost base. The group delivered a 1 percentage point reduction in the cost-income ratio in the period, with the second half costs being in line with the first half. Lending growth net of direct costs delivered a reduction of 3.5 percentage points on the cost-income ratio, providing the proof point that the group has the capability to drive the cost-income ratio down as we add scale. Inflationary pressures resulted in a 1.7 million increase in employee costs, which represents 0.9 percentage point increase in the cost-income ratio. Other costs were also impacted by inflation, and we had investment in people and processes, representing an increase of 2.9 million. However, these increases were offset by good progress being delivered under our Project Fusion efficiency programme. A further 2.1 million, or 1.1 percentage point reduction in the cost-income ratio was delivered in 2023. This programme has now delivered circa 4 million of savings between 22 and 23, and we are on track to deliver a further million in 24, and we will continue to identify further opportunities to drive cost efficiencies. Cost of risk at the group level was 1.4% and in line with the full year 2022. In consumer finance, cost of risk improved materially to 1.9% from 2.9% in 22, reflecting an increased mix of higher quality lending. Arrears in consumer finance have remained stable. Business finance cost of risk increased by 0.2% to 0.9%, reflecting the one-off loss in commercial finance and a small number of default cases in real estate finance. Excluding the single loan loss in commercial finance, the group cost of risk would have been 1.2%, which we think reflects the underlying credit quality of the book. Coverage ratios also remain robust at 2.6% and flat year on year. At a summary level, the balance sheet grew with total assets increasing by 11.8%. Loans and advances increased by 13.6%, reflecting continued strong growth, and customer deposits increased by 14.2%, reflecting that increase in lending balances. Shareholders' equity increased by 5.5% to 344.5 million, and tangible book value per share increased by 4% to £17.80, which I'm sure most of you will notice is materially ahead of the current share price. Our capital position is strong and has improved in both quantum and efficiency with the new Tier 2 issuance of 90 million, a net increase of 40 million in the year. We will continue to evaluate any further optimisation of the capital stack. RWAs increased by 0.4 billion as a result of the growth in lending balances. CET1 ratio decreased by 130 basis points to 12.7%, driven by Firstly, net profits contributing 100 basis points, but offset by proposed dividends consuming 30 basis points, the net reduction in IFRS 9 transitional relief consuming 40 basis points, and the increases in RWAs consuming 160 basis points. Total capital ratio at 15% provides a strong position for growth, and both our CET1 and total capital have significant headroom above our regulatory minimums. Total funding increased by 13.5% to fund growth in lending balances and the 2024 pipeline of new business. We have raised over 1.7 billion of retail deposits during the year, with a noticeable shift towards Access and ISA deposits. Driven by customer demand for shorter-term products, more than 50% of our deposits have a duration of under 1 year. This creates a sensitivity to year-on-year changes in rates. We continue to be retail funded, and 95.6% of those retail deposits are fully protected under the FSCS scheme. During the year, we have evaluated potential options for securitisation to facilitate the replacement of our maturing TFSME, but have concluded that the cost of setting this programme up and the current pricing will be prohibitive. Our current plan is to replace TFSME with retail deposits on maturity during 2025. We remain well funded with significant excesses to regulatory minimums. Thank you, and I will pass back to David so he can give you an update on the performances of our businesses and comment on the outlook.
Thanks, Rachel. We remain committed to our aspirational, longer-term vision to be the most trusted specialist lender in the UK. Our core purpose, to help more consumers and businesses fulfil their ambitions, provides clarity of direction and is a common focus for each of our diverse businesses. As we previously articulated, our new Optimising for Growth strategic priorities will guide our decision-making, and we remain focused on continuing to simplify the group, enhance the customer experience, and leverage our distribution networks. We have made significant progress against those priorities, and some examples are shown for each on the slide. As you know, we have exited 4 subscale businesses and become more focused, and we have streamlined our senior leadership structures as a result. We've reduced the office space we occupy by 51% and plan to reduce the space we occupy in London. Reducing our property footprint and other actions we have taken have helped to reduce our CO2 Scope 1 and Scope 2 emissions by 36% in the last 2 years, and we're making good progress towards our target of a 50% reduction by the end of 2025. We continue to review our operating model, remove duplication, and adjust spans of control as part of Project Fusion. We're now on track to deliver £5 million of annualised savings by the end of 2024, a higher value of savings than outlined at this time last year. We've also now completed the full closure of the Debt Managers Services business and have applied to the FCA to hand back our regulatory permissions for that business. There'll be no further costs incurred on DMS. The net gain on exit was £2.3 million, with the gain on sale recognised in 2022 and the closure costs in 2023 under discontinued operations. Under enhancing the customer experience, we launched our first mobile banking app for our existing savings customers at the end of Q3, making it easier for them to access their account information and transfer money. 1 in 6 of our savings customers registered for the service in the initial months, and 25% of all customer withdrawals on our savings accounts are now initiated via the app. The retail finance team has continued to add new functionality to V12's online self-service portal, and customer adoption has now increased to over 80%. And we've also enhanced our collections and forbearance options in vehicle finance and completed the migration to a modern single collections platform, which now supports customers across all products in that business. On leveraging networks, we're working now with over 1,200 retailers and have continued to expand distribution in vehicle finance. We have over 640 introducer relationships for our consumer products and over 250 dealers for our stock funding product. And we continue to see the levels of repeat business grow in both commercial finance and real estate finance, as our reputation for service quality, flexibility, and speed of response grows. Everything we do is underpinned by our technology platform. We've invested in new capabilities in recent years, and we've continued to increase process digitalisation, replace legacy platforms, and launch new products. In our consumer businesses, we integrate easily with our partners as sales platforms via APIs, allowing us to onboard new partners at pace. Our credit decisioning and affordability assessments are automated, allowing us to provide quick decisions for business partners and customers. Our technology solutions are part of the reason we are gaining market share. And as has been demonstrated, our platform is scalable and has capacity to support our future growth ambitions. So really good progress against our optimizing for growth strategic priorities. So let's look now at the businesses in more detail. I'll start with retail finance, where we provide point-of-sale finance solutions for the benefit of retailers and end consumers. This business really is an emerging powerhouse in the sector. Most of the lending is interest-free credit, where a retailer would pay us a fee for providing finance to their customers as part of their sales strategy, and then customers can repay their product purchases by fixed monthly instalments over a period of time. We spotlighted this business at our capital markets event, and the team did a great job articulating their track record and why they're well placed to continue winning business and make further market share gains. A record level of new lending, 1.2 billion, was delivered last year, helping to grow net lending balances by 16% in the period. We also launched App to Pay, allowing our retail partners and customers to access a shorter-term interest-free credit offer. Market share increased to 13.5% as the team continued to focus on winning business in higher quality, lower risk lending in the furniture and jewellery sectors. These high quality sectors now represent 81% of lending, and you can see that mix change progression on the bottom right chart of the slide. You can also see the impact of that strategy on net interest margin, risk-adjusted margin, and arrears. And arrears remain at record lows. As we highlighted at the capital markets event, not all unsecured lending is the same risk, and our arrears rates are significantly lower than in other unsecured lending products in the market, including credit cards and personal loans. We see further opportunities to grow this business, and we're confident that we can continue to take more share from existing retail partners and that we can gain share in segments that we are currently less well represented in. There are also opportunities to drive digital adoption even higher, and we intend to develop our App to Pay technology as a mobile account management tool for all our retail finance customers. And I'm excited about the opportunities that could open up for us. In vehicle finance, we help customers to buy second-hand vehicles and dealers to purchase their stock for their forecourts. We've continued to make good progress scaling this business, and the team delivered record new business levels of 471 million last year, 24% of which was lending to better quality, lower risk customer segments. This growth follows our technology investment, which has allowed us to introduce new products and serve broader segments of the market, as well as a significant expansion of our distribution network. This growth contributed to our net lending increasing by just over 25% and our market share increasing to 1.2%. You can see the net interest margin and risk-adjusted margin trends in the chart. As we planned for, net interest margins reduced as the mix of better quality lending increased. But the real story is that risk-adjusted margin increased from 6.1% last year to 7.3% as we benefited from improved lending quality feeding through into lower cost of risk, which improved from 6.3% in 2022 to 3.4%. Arrears levels were flat. I want to comment on the two regulatory initiatives in the vehicle finance market that we first highlighted in our pre-close trading statement in January. Regarding the FCA's review of discretionary commission arrangements, we did operate these in the past for a small proportion of our lending. We stopped doing so in 2017. Since we made our pre-close statement, there has been coverage that the FCA's review will consider the time period 2007 to 2021. Over that extended period, a mid-single-digit proportion of new vehicle finance loans included such arrangements. We will provide further information on this once the FCA has concluded its review, which is expected to be in Q3 2024, when the implications for the industry should become clearer. Like others, we've seen an increase in customer inquiries by commissions. To date, 97% of those inquiries are from customers who did not have a loan where there was a discretionary commission arrangement. We're managing those customer inquiries efficiently with the use of an AI tool that we've developed internally, significantly reducing the manual effort it would take to review and respond to those inquiries. With regards to our engagement with the FCA on our collections processes, we expect that engagement to complete in the second half of the year. Looking forward for vehicle finance, we'll continue to expand our network of dealers and brokers to support our growth ambitions, and we'll also complete our platform build this year so that all new business across the product range is written on our modern platform, allowing us to simplify the business and reduce costs further. In real estate finance, we have a focus on supporting professional landlords and developers and helping them to improve and grow their property portfolios. We have an experienced team of bankers with a real specialism in underwriting and managing more complex property transactions. All of our lending is secured against UK assets. The team delivered record levels of new business of £434 million, and that represented growth of 12.7%, despite the challenging interest rate and economic environment. Net lending in this business increased by 11.5% to £1.24 billion. Risk-adjusted margin of 2.2% was impacted by a single development loan moving to Stage 3. That loan had £3.9 million of provisions recognised last year, reducing risk-adjusted margin by 0.3%. Without that, risk-adjusted margin would have been broadly flat year on year. The LTV on the loan book reduced slightly to 57%, reflecting the high levels of security we hold in this portfolio and a relatively low risk appetite. The mix of lending remained consistent year on year, with 84% of lending against residential investment loans, just under 11% in residential development loans, and the remainder for commercial investment loans, so very low exposure to commercial real estate. We're positive about the outlook for real estate lending. Our specialist and bespoke services and partner relationships mean we're well placed to deliver sustainable growth. We will hold a capital markets webinar event focused on this business in the summer. Our commercial finance business provides asset-based lending solutions for working capital finance and for strategic events. Lending is predominantly secured against receivables, typically releasing funds against up to 90% of qualifying invoices under invoice discounting facilities. This business was built organically and is run by an experienced team of bankers with specialist skills in underwriting complex transactions and management of these through their life. The team has a strong reputation across the asset-based lending market, and lending balances were £381 million at the year end. Cumulative growth since 2020 is an impressive 65%. Business is sourced directly and through professional introducers, including accounting practices and private equity firms. New business lending increased by 37% to a record £215 million. We did see 10 client failures last year, higher than normal, as you can see on the purple line on the defaults management chart towards the bottom right. The team successfully managed out of 9 of those exposures without loss, as they have done consistently in previous years. As reported in our first half results, we did experience a large loss on one client earlier in the year, a long-running problem debt case. The cost of risk for 2023 was 2.3% in this business as a result. The team does have a fantastic track record in managing the portfolio though, and the cost of risk since launch almost 10 years ago, including that single loss, was 0.6%. The lessons learned exercise we undertook confirmed there were no loan exposures with similar circumstances in the rest of the portfolio. Commercial finance's net revenue margin grew strongly in the period to 7%. The lending portfolio is variable rate priced and linked to the bank base rate. You can also see that utilisation of lending facilities at 57% remains below pre-pandemic levels, reflecting increased market liquidity more recently, the challenging trading environment as well. We're committed to supporting our clients and continue to leverage our relationships with key introducers to grow further in 2024. So a year of strong progress against each of our 4 diverse specialist lending businesses, and confidence that we will continue to grow these in the coming years. Our savings products are used by our customers to save for special events and generate income. All of our customers receive a competitive interest rate. We only take deposits from consumers, and we offer a full range of products across instant access, short-term notice accounts, fixed term accounts and cash ISAs, and you can see the breakdown of balances by product type at the bottom right of the slide. As Rachel highlighted, there was a move to access products and longer term fixed products from notice accounts in the last year. We raised a record 1.7 billion of new savings balances, and total deposits grew to £2.87 billion. As mentioned earlier, we've seen a positive response from customers to our new mobile app, which allows them to manage their accounts on their phone. And we're also progressing development of the app to allow customers to open a new account on their mobile device. Our savings proposition is an area where we have been able to drive operational efficiencies and cost reductions. We migrated a large number of communications from paper to electronic channels in a year, and we now deliver 59% of these communications to our customers electronically, and we've identified further opportunities to do so. As the bank base rate starts to fall, we expect demand for fixed rate accounts to pick up and for shorter term notice accounts to become an attractive alternative to access accounts. Whatever the customer preference, we're well placed to meet their needs. We have a clear focus on our specialist lending businesses, where we've proven we can win and take market share, evidenced by our loan book growing by £1 billion since 2020, growth of 52%. Although more focused, we remain well diversified. Our business model has proven to be resilient through challenging periods, and this remains a strength of the group. We've been improving the credit quality of our lending in our consumer businesses, and as you've seen today, despite a large loan loss in our business during the first half of the year, the group's cost of risk remained low and stable at 1.4%. Our optimising for growth strategic priorities are guiding our actions to simplify, enhance the customer experience, and expand and leverage our distribution networks. And I'd like to leave you with 3 key messages. We have excellent growth potential in large addressable markets. We're on track to deliver on our upgraded target of £5 million annualised cost savings by the end of this year. We have sufficient capital to support our growth plans, and our results demonstrate we have really good momentum towards achieving our £4 billion net loan book target, the level required to support our 14 to 16% returns target. We are very pleased with our underlying performance and are confident in and excited about the future. The next update from us will be the Capital Markets webinar event focused on our real estate finance business. That will be held on Wednesday, 3rd of July, and we'll issue invites well ahead of time. That brings this morning's presentation to a close, and we're happy to take any questions that you may have. Thank you.
If you wish to ask a question at this time, please signal by pressing star 1 on your telephone keypad. If you wish to cancel your request, please press star 2. And please make sure the mute function on your phone is switched off to allow your signal to reach our equipment. Again, it is star 1 to ask a question. The first question comes from Gary Greenwood from Shore Capital. Please go ahead.
Oh, hi, guys. I just had a question on costs. Obviously, 2023 was, I think, quite a good performance with costs up 7%, given the inflationary backdrop. You're targeting reducing the cost-income ratio quite a bit over the next few years to 40-60%. And just want to sort of get a sense of how confident you are of achieving those targets and sort of what you need to do to make sure that you deliver. So if you could just talk maybe a little bit about sort of further operational changes that you might have to put through the business. Thanks.
Okay, thank you, Gary. Thanks for joining the call. Listen, the £5 million figure that we've called out annualised savings are things that we've identified already. As I mentioned there in the webinar, we're not going to rest there. There's plenty more that we want to keep investigating. It just needs to become part of the habitual operations of the business that we're continuing to look for efficiency savings. So looking ahead in terms of potential further beyond the 5 million, it is, as you're looking at the operating model, structure of the organisation, where are there opportunities still to remove any duplication that might still exist within different teams doing similar tasks. Clearly, a big focus will continue to be the digitalisation of processes, particularly those that interact with customers. So yes, we've seen a very positive start with the mobile app take-up and savings. That is for existing customers servicing an account. There's still more penetration also in take-up to go after, but we're also working on the development of the mobile app to be extended so that new customers can apply. And typically there are quite a lot of manual processes when you are setting up a new account in our savings products today. So there's more opportunity to go after that. We also have a little bit further work to do on property rationalisation. The footprint in London is probably beyond what we now need. So we will continue to look at that. And there's still a little bit of technology work around the vehicle finance business, where we are still writing our near prime business on our older platform. All the other products are now on the new platform. And so this year we will finish the job there, so that we are on a single platform for all new originations. So, combination of looking at structures, digitalization, central overheads like property, and the opportunity with IT simplification of systems to continue going after additional savings on top of the fact now.
Hey, thanks. I just had one other question, if I can, on the interest margin outlook, and just in terms of how we should think of that evolving as interest rates start to fall.
Yeah, Gary, I'll pick that up. So, I mean, we delivered 5.4, which was the same between the two halves of this year. There is pressure in terms of costs of funding. I mean, we raise our deposits in the market and we have to be at the top of the tables. But as you say, we are looking now, hopefully, towards a curve that's coming down and rate cuts. So we will actively manage that pass through on both sides of the balance sheet. The other point probably is what I tried to call out on the waterfall, that as we continue to make even small moves between the mix of the portfolio towards consumer, we see a margin expansion coming from that just by the nature of the yield on those products. So it's both of those. I'd say that 24 will still be some pressure in terms of being able to raise deposits at good rates, and our ability to look at that pass through on the asset side will continue to be a focus in 24. Then hopefully in 25 it'll be a little bit more stable and we'll be able to see some of those positive changes on the mix towards consumer.
That's great. Thanks for taking my questions.
Thanks, Guy.
Next, we have a question from Rob Murphy. Edison, please go ahead.
Yeah, hi guys. Just a quick question on the mix shift to retail, and I noted DFS had a bit of a profit warning the other day, so maybe you could say something around that. And then just coming back to the net interest margin question again, have you basically factored in the curve into your estimates, or have you made any other assumptions around that? Thank you.
Thanks, Robert. I'll pick up the first point on retail finance. So we are not seeing any impact in our retail finance business of the pressures that some larger retailers in particular sectors that we are active in at this point in time. Now, that's not to say that that doesn't flow through. Our overall performance has benefited from the fact that we're actually taking a larger share from some larger clients than we've taken historically. So as you know, one or two larger clients operate a range of potential lending agreements with different lenders in place. So we've been able to take a sort of larger share, and that to this point has been offsetting any potential reduction in overall demand that particular retailer might have. So we're open-minded to the fact that that pressure may build. I mean, our view looking forward is a bit more positive in terms of the outlook for consumers. Clearly, you start to see that this is now the peak of the interest rate cycle, and no doubt we'll get some commentary in an hour and a half's time on that. Then I think you'll start to see, as seems to be building in the last month or so, a little bit more positivity about the consumer outlook. So it's a sort of timing point here. You've still got some consumers who are still likely yet to feel the full impact of the rate rises that have already gone through, particularly their mortgage holders, and they've yet to reprice on a fixed term arrangement. However, beyond that, you're looking forward into a lower rate cycle, which generally does tend to feel a little bit more positivity on outlook and confidence. So we're not seeing any impact yet. Certainly taking a bit more share from larger clients, are aware of the potential risks, but also positive about the outlook and how that might feed through into consumer spending as well.
Just on your question on NIM, yes, we do obviously plan for the yield curve when we're looking at our forward numbers. So we have the assumptions that were around the Q4 of last year. So there is an assumption that the base rate does start to come down towards the back end of this year and obviously into 2025. So yes, that is baked into our forward numbers.
Yeah, and just to add to that, I think the reality is if you look at commentary from other banks, you have to remember that our specialist lending model is very different from some other banks, particularly those very large exposures to residential property in particular. So they have called out that they have seen their net interest margins peak. What we are seeing today is we remain very comfortable looking forward with our net interest margin target of just above 5.5%. So yes, there's a little bit of pressure on that, the reasons that Rachel's mentioned, and we're at 5.4 for the 2023 year, but we remain very confident in the 5.5% level.
Excellent. Thanks, guys.
Thanks, Rob.
Thank you. As a reminder, to ask a question, please signal by pressing star 1. We'll pause for just a moment to allow you to signal. And as there are no further questions, I'd like to hand the call over to for any web questions, any webcast questions.
Thank you. We have one question from Jan Ehrenberg at Investec. There are two parts to the question. The first part is, some of the retailers within your consumer businesses have seen some challenges to their financial performances, for example, Watches of Switzerland and DFS. Could you provide some color as to what extent this might impact your lending operations? And the second question is, after a year of strong loan book growth across the business, do you have a view as to which parts of the business are likely to sustain some of this into financial year 24? Any of the divisions that you are particularly excited about, having almost finished the first quarter of the year?
Thanks for the questions, Jens. I'll take the first one is really a repeat, I think, of the question we've just had on the retailers in particular segments. So, I would just give the same response to that rather than repeating it. On the business lines, listen, we have plans to continue growing these businesses. What we did call out to the Capital Markets Day in November is that we were retiring the target to grow at 15% CAGR, recognising that we're in quite uncertain times, and more important was to refocus onto a 4 billion net loan book target, which is a required level to unlock those medium-term targets, particularly the return on average equity. So we have plans for growth. As I said in response to a previous question, the outlook is looking perhaps an interest rate environment looking positive, and hopefully we'll see some benefits of that in the second half. But we're not seeing anything currently that is impacting our view about moving towards through 24 and into 25, that £4 billion level. And as called out in the presentation earlier, having grown 52% our lending over the last 2 years, then you clearly will need to grow roughly about half, just under half of that level again to get to the 4 billion target. So opportunities still exist in each of our business lines. We've got plans for growth in 24 and 25 in each of them. And we believe that with a favourable wind on the economic outlook improving, that will solidify our confidence in getting to the £4 billion level.
There are no more questions over the web, so I'll hand back to the conference call host.
Well, thank you everyone for joining the call and also for the questions. 2023 was a year of strong progress in a challenging environment. We've continued to see growth momentum with net lending book growing by 13.6% and extended our distribution in our consumer businesses and gained market share. We continue to see, as I've just said in response to the question, excellent opportunities for growth in each of our large addressable markets. And we continue to deliver operational cost savings and are confident in achieving that £5 million enhanced target by the end of this year, and still looking forward what else we can get out of the cost base. The growth we've taken to simplify the group and a more disciplined approach to managing those costs gives us great confidence in getting to the medium-term target for cost-income ratio in the 44 to 46% level against a £4 billion net loan book. And again, as we've just reiterated, getting to that level is now within our reach. It's on the horizon. It does require growth, but growth at a much lower level than we've delivered in the last 3 years. We do have a strong track record of growing each of these businesses and put clear plans to continue doing so. So we are confident we've got the right team, the right capabilities, and the right distribution partners to deliver on those commitments. We hope that you can join us for the capital markets webinar that we'll be holding in early July on our real estate finance business. It will just be an opportunity for you to meet more of the team, understand what they have delivered in recent years, and more importantly, the outlook for positive growth continuing. So we look forward to meeting people and seeing you then. And likewise, there's quite a number of you we'll be meeting in the course of the next few days. So Rachel and I look forward to discussing the results in a bit more detail with you. But thank you for joining again, and have a good day.